When you get a policy from our team and it's designed properly, you will have high early cash value, whether we're doing a 60-40 or 75-25. When we design them, the reason we're asking what you're trying to accomplish, that's going to drive how we build the policy. This is a long-term game. You are in full control of when and how that loan gets paid back. Do you want to pay all that money out and have your dollars leave your economy? Or would you rather come up with a strategy where you can put your money into your own system and leverage it, pay your debts off, and then recapture it? All right. Hello, everyone. Yeah, so Chris is out in Pittsburgh today and was doing some live events. I think he's on his way now to Salt Lake. Today, I will be hanging out with everyone and taking some questions, but it's kind of a last minute plan. What we're going to do is go over some policy design questions and how we approach policy design. And Gabby, I don't know is there anything you want to announce about the upcoming PMC event in Orem and
yeah, I just want to remind everybody, the team will be out in Orem, which is close to Salt Lake this weekend. It'll be our first workshop event. So anybody who's attending that, definitely give your feedback. We're always looking to improve. And then, so that's our West Coast. We will be having an East Coast coming up in, I believe, August. So if anybody wants to jump on that, then I can share the link as well. But yeah, we're really excited about this one. We'll have a lot of great speakers, a really good time. There's also, similar to our experience, there's also a little experience along with that one as well. It's really cool for VIP attendees, and the VIP sells out, very quickly. So if you do want that experience next time, make sure you get in the VIP as well.
All right. So it looks like we've got some people already out in Orem, which is awesome. I'm going to unfortunately miss this one, but wish everyone a great time and try to make the next one anyway. Who here wants to talk about some policy design and how we approach that? Looks like Wilbur does. Hey, Wilbur. I know you and I were supposed to talk this week, but it sounds like you got set up. That's awesome. Last week, we spent some time talking about, the drag cars and the aircraft carriers. I don't know if everyone was on that one, but what we learned from that was when you're investing and using the policy first to put the money in and then take it out, what did we find out? Does anyone remember what we found out last week about the policy investing from a savings account versus investing from a policy? Does anyone remember that? Jets go faster long term, right? Jets go faster long term. In the short term, the top fuel dragster beats the jet. But one of the things that, just as a reminder, we talked about last week was that using a savings account in the early years actually performs better than using a policy. And that typically happens, that crossover is about 5 to 7 years. And some of that's going to depend on policy design. So I want to kind of follow up that conversation we had last week with how do we adjust the policies? Why do we do a 60-40 versus 75-25? And for that dump in concept, why would we want to do a dump in versus not doing a dump in? Does everybody know the concept of what the dump in means? There's a few things that I want to talk about in terms of policy design. So, and we'll talk about the dump ins in just a moment. When we're designing policies, the first thing I want to know is, what are you trying to do with this policy? And there's really 3 main pillars that I would put people's use cases into. There could be many, many more, but the first one would be, let's say I want to pay off debts. I've got a bunch of debt and I want to be able to structure a policy where I can run my money through the policy before paying off the debt. So there's a number of use cases out there that show how that works. In a debt payoff situation, we may structure the policy to have a little bit more cash available up front so we could use that to pay off those debts. Use case number 2 that we oftentimes hear people talking about is, hey, I want to prepare for a major purchase that I have coming up in the future. That could be a car purchase. I've got a truck I'm going to buy, or maybe you have small children and you want to start preparing for college. There's nothing wrong with putting the money in and capitalizing that policy, but you may want to use that, if you're doing a longer term plan where we're capitalizing for a college or something 5-10 years down the road, we could still use that money while it's capitalizing, but we would typically structure that policy to have a little bit less cash value accessible up front so that it gets more performing in the later years. And then the third use case I would say that we deal with on a very regular basis is, hey, I want to do some investing. So let's say that I'm going to do a private lending deal in the private money club. Well, option one, like we learned last week, is I could just take that money out of my savings account and deploy it into private money club. And I could earn some interest payment, and that can come back into my system. Alternatively, I can put that into a policy before I go do that private lending. So we talk oftentimes about add one step to your flow, which is to run the money through the policy, then out to that investment. So how would I design a policy if somebody wanted to be able to use that for private money club or for private lending or for real estate? That's a depends question. So if you're dumping in a lot of money, we can oftentimes get about 90% of that in, and I'll talk more about the dump in. So it really is going to depend on how much money do you need to do that private lending deal? How much do you want to put in the policy? And that's going to kind of determine whether we end up going down the road of a 75, 25, 60, 40 and whatnot. Quick quiz for everybody. There's trade-offs with everything, right? So if I take out cash earlier in the policy, there's got to be some trade-off if I don't take cash out as early. Can anybody put in the comments of what are those trade-offs of having more cash out or less cash out in the early years of the policy? So what I'm looking at is if I structured a policy where I could get a lot of cash out in the beginning years, what does that look like versus if I kind of back it off a little bit? Okay, so Eve is saying it takes longer to break even. Taking cash earlier would take longer to break even. So John, Eve, you guys are on track here. Less death benefit, more cash means less funds compounding. All of these are good responses. Think of it this way. It's kind of a balance, because the faster I can have access to cash in the policy, the slower it will grow in the longer years. So here's a case study that I did recently so the gal was in her early 30s. She wanted to put in money for investing. And so the question was, if we use the exact same premium, the exact same amount of dump in, and we do a 60-40 versus a 75-25, at what point do those two policies, where are they equal in terms of the amount of cash value that is accessible? And here's what happened. It was year 17, meaning from year 1 to 17, the 75-25 had higher cash value. At year 17 and beyond, the 60-40 had more cash value. So that's where the point where they crossed over. So it doesn't always make sense to do a 75-25 or a 60-40. It's just going to depend on when we want the cash, because we're making a trade-off there. We're trading off longer term growth for earlier cash. That's essentially the gist of it. Is the faster I get the cash out, the less performing it will be in the later years. But for her, being year 17, we had made a decision, or she actually made the decision, and I just kind of helped clear it up, is can you do something with that cash in 17 years that would push that crossover point down further? So we end up going with 75-25. I was just on the phone with another fella, and he was talking about Chris's video that has the policy designs of the HECV, the 90-10, the 60-40. And I think Chris is going to be redoing that, because some of that stuff is based on the old rules, the old guarantees at 4%. But one of the things that this particular person said that was helpful is understanding policy design and commissions. And I'm just curious in the audience, have any of you run across Chris's video where he talks about how he lost $534,000 by doing infinite banking? Can I just get some yeses, nos? Yep. Awesome. So here's the fun thing about that is it's a catchy title, because Chris didn't actually lose money by practicing infinite banking. But where his point was is that because of the way we design these policies, we're designing them for your benefit, not for our commission. The way the policies work is when we talk about a 75-25 or a 60-40, guess which one has higher commission? The 60-40 would have a higher commission than a 75-25, but we don't make the decisions for your policy based on our commissions. So let's rewind all the way back to, what does a traditionally designed life insurance policy look like? If you told me, hey, Craig, I've got $10,000 and I'm not an infinite banking practitioner, I'm not someone that knows anything about infinite banking, but I'm going to sell you a life insurance policy. Guess what I'd do? I'd put 100% of your premium into base. And guess what that's going to do? It's going to create the highest death benefit. It's going to create the highest commission for me, and it's going to create the lowest amount of cash value growth for you. So I've got people sharing policies with me all the time. And when I look at these traditionally designed policies, they may have put thousands of dollars into those policies. And by year, let's say year 3 or 4, there might be a couple $100 available. This is why you hear in the marketplace, the Dave Ramseys and the different folks, life insurance, whole life insurance is garbage. And that's why, is because the 100% of your premium is going into base, which doesn't create any cash value. So when we talk about a 60-40 or a 75-25, we're taking that $10,000. Let's just use a 60-40 as an example. When we take that $10,000, we're breaking that into 40% as base. So $4,000 goes into the base, 60% or the $6,000 goes into the paid up additions. The paid up additions is a rider that helps generate the cash. And that's why when you get a policy from our team and it's designed properly, you will have high early cash value, whether we're doing a 60-40 or 75-25. So that's just a little bit of philosophy on some of the ways we're doing the designs, some of the things that drive our design. So when you're talking to our mentors, it's very important that you share, what are you ultimately trying to do, and in what time frame are you trying to do it, and how much money do you need out? So those are all the things that help us with the actual design of the policies. One of the things we're working on is Chris is going to redo some of these videos. And so what we're doing is some policy design for Chris, just to show, how does a 60-40 work if I'm putting in, say, $10,000 a year? How does a 60-40 look if I'm doing a dump? What's a 75-25 look like? So we have a number of different policies here that we can go over. Now, what you're looking at is not an actual illustration from the insurance company, but it's a cash value analysis that I'll oftentimes do for people I'm working with. It's kind of a double-edged sword, because the insurance companies don't necessarily like us taking data out of their policies. But what I do is I just take the illustration, and let me just show you what I'm talking about here. I'll pull one up, 60-40 illustration. So for those of you that have looked at illustrations before, there's a lot of great information in here that talks about what are the different riders. But let me go down to the actual illustration with the data in it here. So this might look familiar to some people, where you've got the kind of the table of guarantees and non-guaranteed. So before we go further, let's just talk a little bit about what this includes here. So in the illustration tables, they'll put the age, the year of the policy. Now, all of these numbers that we're seeing in here, those are representative of the end of the year. So at the end of year 1, this would be our death benefit. At the end of year 2, this is our death benefit. And what we'll do is we'll look at the guaranteed side and we'll look at the non-guaranteed side. So in your contract, when you get a life insurance policy, there will be a contractual guarantee in there, whether it's the 2% with Lafayette or say 3.25% with One America, but that's in your contract. That's what's driving these values over here under the guarantee that say net cash value and the death benefit. This is what you will see as a guarantee. Now, on the right-hand side, you'll see the list of non-guaranteed, which include the dividends. One thing we have to make sure we make clear is dividends are not guaranteed. They don't have to be paid, but I'll tell you this much. They've been paying them. So Lafayette has been around, I think, since 1905. One America was around in the later 1800s. So 140 years, and over 100 years, I'd say, with most companies, they've never missed paying a dividend. So although they're not guaranteed, they paid them through world wars. They've paid them through the Great Depression. Banks have failed, and insurance companies are still paying dividends. So that's pretty cool. Although they're not guaranteed, I feel pretty comfortable that they're going to continue to be paid. That's where these non-guaranteed numbers are coming from. annual dividend, the increase in the cash value, your net cash value. So what I do for these cash value analysis is I scrape the data out of here, out of these next few pages, and I put it into this cash value analysis because essentially what we're really going to do is just take a look at these numbers, pull them out of the charts, and do some analysis on them. So anyway, that's what the illustration looks like for anyone that has not seen one. Now I'm going to jump into, this is the cash value analysis, and I'm going to see if I can make this a little larger as well. What is a cash value analysis? What are these numbers? What does all of this stuff mean? Again, we've got the policy year, the annual premium that's going in, and above you'll see if there was a dump in, what the premium is and what the split is of that base. So in this case, 75%. Actually, I want to go to the 60-40 first. Let me see if I can find. All right, we're at the 60-40. The 10,000 on a 60-40 means that $6,000 goes to paid up additions, 40% or 4,000 is going to base. I did mention the dump in a couple of times, so I guess I should talk about that a little bit more detail. The premium is the thing that you're doing on a consistent basis. So if I'm putting in $10,000 premium and I'm doing it annually, I make one payment for the year. Next year, I make another payment. There are options or different modes, as the insurance company calls it, where you can pay monthly, you can pay semi-annual, you can pay quarterly. So essentially those four modes. What is the benefit of doing an annual premium? The money is in there all from day one, as opposed to if I'm doing monthly, it just takes a little longer to get the money into the policy, so it's not growing from day one. Is that a good thing or a bad thing? Well, let me tell you, I think a good thing is whatever works for you. If your cash flow requires, and it works better to pay monthly, then just pay monthly. There's a little bit of charge for that, but it's more important to make it work with your particular funding. So if annual can work, great. That's the best from getting the money in the policy all at once. Now, if you do a dump in, that's essentially taking a sum of money. Typically, that's some cash that you might have in your savings account. Maybe you're doing real estate and you just sold a deal and you want to run the money through the policy. What we do is we dump that into the policy. So in this case, if I put in, let's say 50,000, and then I'd have another 10,000 premiums. So my first year would be 60,000. And I'll show you what some dump-ins look like, because you'll have a lot higher cash value from day one when you do that dump-in. So I'm going to go over 60-40 without a dump-in, a 60-40 with a dump-in. Then we're going to look at a 75-25 and a 75-25 with a dump-in, just to give you some ideas of what the policies grow. So in the cash value analysis, you've got your guarantees. Remember, these are going to be in the contract. There's a guaranteed rate in your contract that drive these numbers. The non-guaranteed numbers are everything in this blue. So when the insurance company projects out, they typically take a conservative approach to say, based on what we know, this is what the dividend projections look like. And they're going to kind of, run that out through, to year one until you're 121 years old. So that's how that works. The projected cash value is going to be, what is the cash value growth along with the dividend? This next column, what I'm essentially showing here is I put in $10,000 into the policy year one. We have $6,572 of projected cash value. That means I have $3,428 less in cash value than I put into the policy. This relates back to last week, which was the top fuel dragster versus the jet. If I'm putting $10,000 into a savings account, I still have $10,000. And that's why the savings account is a little bit faster in the beginning years. But don't forget about this thing over here, this death benefit of $161,000. A savings account wouldn't have that. So if you have a family that you care about or someone that you care about, this is huge in the beginning years when we still have that little bit of a deficit. But what I want to know is, when do we get to that point where the amount of money we put in is at least equal or greater to the cash value? And in most policies, in this particular one, it was year 9, but in most policies, this can be year 5, year 6, year 7. It just depends on the policy design itself. So that's the projected premium to cash. And then we look at the projected cash value growth each year. So as I put in more money, how much did my cash value growth? And then the other measurement that I like to track is this cash on cash number. So what does this mean? Without looking at the policy, if I have $1 and I put it into a thing and I get $1 back, that's what we consider 100% cash on cash. When I put $1 into the policy, I'm getting about 65 cents back year one. Year two, I get about 85 cents back. Year three, 90, 95, and then 101. We're typically seeing the cash on cash go positive at typically year 3 or 4, but in this policy, it's year 5 where we get that 100% cash on cash. And how you can really see that is I put in $10,000 here in year 5, and my cash value has grown, or my projected cash value for that year has grown $10,122. So I'm putting in $1 and I'm getting a buck 22 back. So that's where we start make gains from then on out. So, if we scroll down to year 20, so we put in $4,000, yet we grew 11,606. We have 290% cash on cash. All right. So any questions? I know I threw a lot of table data at you, but any questions on this so far? Is it making sense? Is it helpful? So what I want to do now is look at this annual premium column, because you'll notice that it's $10,000 up to year 10, and then it drops to 4,000. Why is it dropping to 4,000? And why do we drop it to 4,000? And then there's a question Wilbur has is, why is the death benefit dropping in year 2? So the death benefit's not dropping, Wilbur. In some cases, it does drop. What I'm looking at is the projected death benefit increase. So year 1, we start off with 161. Then it increases 13, increases 13, increases 14. So if you look at this column, the death benefit is actually going up every year. So but we do have some policies where sometimes you're going along and the death benefit might be $1 million and it drops down to say 400,000. That is driven by the fact that sometimes we have to put term into the policies. Where's the break-even year? I look at the break even, there's 2 different break evens that I look at. One is the cash on cash. So if I put $10,000 in, when do I have at least $10,000 of growth? For this particular policy, it's year 5. We have designs where sometimes it's year 2, sometimes it's year 3, sometimes it's year 4. Just depends on how we design that policy. The other break even that you might want to consider is, well, if I put in $100,000 by year 10 and I have 103, or even at 90, I've got a little bit over 90. So my break even might have been year 8, 9, or 10, just depending on my policy design. One of the things that Nelson Nash talks about in the becoming your own banker book is this is a long-term game. So if you have any intentions of, say, putting money in for 3 years and then wanting to get out, you're not going to be ahead in terms of how you put money into the policy and got money out. Depending on how you use that money, you might be ahead. All of the numbers here are going to be representative of just funding the policy and doing nothing else. But what we teach is we're not just going to put the money in and leave it. We're going to take this money out and do other things with it. We're going to pay down debts. We're going to prepare for, buying that car, or, paying for children's college. Or the third thing, which I really like to do the most, is take the money out for investments. So Ron looks like closing on a home, taking out the proceeds to start infinite banking. Can you show an initial deposit of 100 and then 12 annual? Also, can you put more than the 12K in? If not, how do you do that in years later? So Ron, I don't have that particular policy design, but we can certainly do something for you on that. But these policies, when we design them, the reason we're asking what you're trying to accomplish, that's going to drive how we build the policy. Ultimately, if we design it properly, we're not going to leave a lot of room. For example, if you're putting in 12,000 a year, you won't be able to come back and put in 50,000, because the policy is designed and optimized to run with that 12,000 yearly premium. So what do we do in those cases? The first thing I always look at is, do I have premiums to pay? Have I paid up my paid up additions in full for the year? What do I mean by that? Well, if we're doing $10,000 a year and it's a 60-40, $4,000 of that $10,000 is base. So could I pay $4,000 and just keep the policy in force and moving along? Yes. That means I've got $6,000 that I didn't pay for that year, I can always go in and backfill that. So question one is, when I have extra money, have I paid my premium in full with my paid up additions? Okay, if that's a yes, then the next question I ask myself is, can I do something else with that money to redeploy it into an investment? And if I don't have anything to deploy it in right now, do I have a loan on that policy? If I have the loan, then I'm just going to go park it back and I'm going to go pay that loan off, which then increases my available cash value to take out later. So to answer your question, Ron, there wouldn't be a way to put in a lot more than that 12K, but there will be a little bit of room. And what we have to work with is in the MEC, the modified endowment contract, which is the rules that the IRS set up for us. So Ron's using it for real estate. Yeah, so Ron, as you're using the policy, you're going to be putting money in, taking it out, and then if you have more money than you can put into the premium side, it may make sense if you don't have a use for it, just to put it back into the loan itself, so it allows that capital to be built back up and reused later down the road. David asked a good question as well. So when we do dump-ins, and that would be if I say we're to throw 30,000 or another 10,000 into this policy from day one, do you get dollar for dollar out quicker? Well, the way it works with dump-ins, I typically say you can get about 90% of that dump-in out. And there's probably a lot of people on here that have actually done dump-ins. Like, oh no, it's way higher than that. I always try to be conservative. You might get 95%, you might get 90%, 95 to 90, 9 to 95 is where I would typically look at that. So it won't be dollar for dollar, but you will get a pretty high percentage of that dump in out within the first 30 days. So John was asking if this has a term policy inside of it. And I don't know, but I can find out. So in your policy illustrations, I'm going to scroll past the illustration. And what we're going to do is go down and look at this premium page. And in the premium page, it'll show you how your premiums are broken down into the base. It looks like there is a term rider in here for $75,000 and it's $159. So this particular policy did require term. So why do we want to put term into the policy? It's not that we want to, it's that when we're designing policies, the amount of money that you put in has to be equal. There has to be a certain amount of death benefit coming along for the ride. So prior to, I think it was 1980, I don't remember the exact date, but somewhere in the 1980s, prior to that, people were able to shove a lot of money into the life insurance policies, and it was a party. And then the IRS comes along, and I don't know if anyone is a big fan of the IRS, I'm not, but if they came and ruined the party and they said, all right, we're going to put some guardrails around the policy and how it works. And what they did is they said, you can only put in so much money related to a certain death benefit. And if you go beyond that, it will become what's called a modified endowment contract, which then becomes taxable. So all of our designs that we do will consider the MEC. And if we have to put term into the policy to make it work, well, so be it. It's better to do that than to have a modified endowment contract. So that's why you might see some term in the policy. But the place to find that is to go down to this page, page 13 with Lafayette, and they'll simply show you this is your base, this is your term, and this is your paid up additions. So of that $10,000, this is how it's getting broken up. And then this is the amount of term that got added to that policy. Okay, so Eve's asking if that charge was a monthly charge. And so that looks like it is a annual, because this is our annual premium. So not a lot of term on that one. So Matt is talking about how he just did a dump of 20K and got 19,990 back. So there's a case where the dump in was able to provide a lot of cash out. And that's why I just always take a very conservative approach to let people, as we're planning, 90% to 95%. But in Matt's case, got a lot more out than that. So that's awesome. Maria is asking, does the percentage out within the 30 days have to meet a certain criteria? It doesn't have to meet a certain criteria, but this actually brings up a point. I talked to a lot of people throughout the week, and Gabby, I know you talked to a lot of people throughout the week. Let me talk a little bit about what's available to take a loan from, because it's not showing here on what's available in terms of a loan. typically when you log into your account, whether it's with Lafayette, One America, or whatever it might be, they'll show you how much of your cash value is available to take a loan. I get a very common question, or I guess a misunderstanding from people. So you see on this policy where we've got year one, it's got $161,000 of death benefit, but our cash value is $6,500. There's a common misconception or confusion out there where people think they can borrow from this 161. So I could take 150,000 out and borrow from that. I think where that confusion comes from is that, Chris will talk about in the videos, we talk about in the videos, you can borrow from your policy and you're using your death benefit as the collateral. So if anyone's out there confused about that, you cannot take this death benefit, this 161,000, and take a loan. What you're able to take a loan from is a percentage of the cash value that's in the policy. And as a rough number that I use, I just look at this cash value and say you can get about around 90%. Sometimes it's a little bit less, but around 90% or so of the 6,500 would be available to take a loan. So when you're trying to plan out how much money is available, how much can I get, from day one, that's more or less the number. So Matt shows depositing 25,000 for 15 years, then it drops to 6K after that. Is that for the term, right? Or does that time frame change if I add? So Matt, I would need to see the policy, but I would suspect that 25K, if you go into your illustration, and I don't know if this is with Lafayette or One America or whom, but if you go past the illustration page, it will show you on the illustration how much term is there. Is it a 15-year term, a 7-year term? And just take a look at that. One America. Okay. Yeah. So just take a look, and after the first illustration table, there should be a payment page, and it'll show you what's available in terms of, how the term's being paid. And so I don't know why that policy would be designed for 25 for 15 years. We're typically dropping paid up additions after year 10, just like in this one. That's why it drops from 10,000 to 4. Now, does this mean that I can't put $10,000 in for year 11? I can if I continue to pay my paid up addition rider. So there's about I think it's about $121 is the rider fee. I suggest whether you want to pay the paid up additions past year 10 or year 7 or wherever it cuts off, I would at least pay that rider fee because it allows you to go and put more in later. So if I wanted to put in that extra 6,000 in year 11, I can. But if I don't pay that rider fee, that door is shut. You will not be able to put any more money into the policy. So Matt, I don't know if that helps answer, but I would just take a look at your illustration and just see what's in there. So Eve is asking about the cash value. So the insurance company is not going to allow you to take 100% of your cash value. They'll let you take a lot of it, but it's typically going to be around 90%. So if you log into your, whether it's One America or Lafayette, I don't remember what company you went with, but if you log in there and you look at your cash value, they'll also show you what's available for a loan. And that will be a little bit less than what your actual loan amount will be available. When paying back a loan on a policy, are we always allowed to pay back the loan early? Any special rules, limitations? So here's the cool thing about loan repayments is you get to make the decision of when that gets paid back and how that gets paid back. And again, going back to if it's a debt repayment or if you're doing investing, there's different reasons why I may pay the principal back or I may just pay the interest back, but you are in full control of when and how that loan gets paid back. So there's no early payment issues. If you pay that loan back in full throughout the year, that's not a problem either. You can pay that all back. Or if you don't pay anything back, what happens, I'm going to take a quick side road on loans, just because I want people to kind of understand this piece as well. So let's just say that you take out a $10,000 loan, and what'll happen is if you're not making any payments throughout the year, you'll see that it'll take your 10,000, do an interest charge. And right now I'm doing a 5.24% interest charge for the month. So you'll see as we go through the year, at the end of the year, I'll have an interest charge of $524. And at the end of your policy year, the insurance company will say, hey, Darren, you've got $524 of insurance. Would you like to pay it? And if you do, great. If you don't, it's going to get added on to the principal for the following year and then just continue on. Now, here's what's cool about the loans. They're simple interest as opposed to a amortized loan. So let's just say that we're going to pay $500 back to this loan every month. So when you make a payment throughout the year, you're going to pay 100% of that payment is going to reduce the principal. So you see this 500, it reduces my principal to 95. The next 500, I go down to 9,000. But here's what's cool. There's this concept of that, although the insurance company says your loan is 5.24% with One America, it's really not 5.24% if you're making payments throughout the year. Look at my interest charge for the year. It's $354 or 3.54%. The reason is because this is not an amortized loan, but it's a simple, which means all my money I'm putting in throughout the year is going to principal. But if I wanted to, I could just come in and pay the remaining balance of $5,771 if I wanted to. So I could just pay it off at month 8 if I wanted. That's the way the loans work. So Eve is asking about the auto payment. So right now, your auto payment is taking PUA and base. And so you're asking what happens at year 11. So here's what I had to do. So my oldest policy is 14 years ago. So a few years ago, I just called up Lafayette and I said, because they had the payment set up to take out my PUA and my base. So I just called them. I said, hey, can you break the payment out just to take the base out from now on? There's a button where I can put in the paid up additions if I want to add to it, because I am paying that rider fee. So what'll happen is you'll just let One America or Lafayette or whomever it is just to take out the base, and then you can make PUA payments if you want going forward. Andrea, there's a question about, is the 5% interest paid on a loan paid back to your policies or paid to the insurance company? So this is where we spent some time last week going over the components of your bank. When you put money into a life insurance policy, it goes into your premium bucket. When money goes into that premium bucket, it compounds uninterrupted for the rest of your life. The cash value bucket is going to be a representation of how much cash value do you have available to use. This is essentially an advance on your death benefit. So if you have a death benefit of $1 million and you have 50,000 cash value, the insurance company is just saying, hey, we're giving you an advance if you want to use this cash value. And then you have the death benefit. Now, every time you take a loan from the insurance company, it's coming out of this general fund of the insurance company. So when you pay the loan back, that money goes back into the general fund of the insurance company. So in my example, we took out a $10,000 loan, we made all these payments, and we paid our loan back in full. That all goes back into this general fund of the insurance company. But when you pay that loan back, your available cash value bucket goes back up because you've repaid that loan, which now makes your cash value increase. So we talk a lot about if you're overpaying your loan. So if I overpay my $10,000 loan, where does that go? Well, that's where, if we have room in our policy, we will put it into our premium bucket. And so here's the example. If I'm doing debt payments and I have a car payment that I am on the hook to pay, say, $500 for the next 5 years, if I use the policy to pay down that car faster, I'm not done. Nelson Nash talks about this in his book about the grocery store, don't steal the peas. Whatever you do to a third-party debt system, do to your own system. So in this case, I'm going to pay my car loan off faster using my policy, but then I'm going to continue making that same amount of payments back into my own system. So two things are going to happen. One, I'm first going to pay back the life insurance general fund. All that is going to be repaid. Then if I have room in my policy, I'm going to put that into my premium bucket. That could be, those debt payments could be paying my premiums for year 2. But if we get to the point where we just can't get any more into our policy, put it in a segregated side account and accumulate it for maybe next year's premium. Or if you get to the point where you have too much money that you can't get into a policy, congratulations, you've got a great problem on your hands. Let's start another policy and we can start filling it up that way. Hopefully that helps describe what happens with the loans. If not, let me know. So we do have another question here. Can you decide later if you want to add PUA if you want to continue higher premium instead of dropping premium from 25 to 4? Yes. So when we look at this illustration, although I'm doing 10,000 a year and I drop to 4, if you pay the paid up additions rider, which is about $121, it keeps the door open so that I can continue to put more money in. Now, as the policy changes and grows and goes over time, let's say that you're paying 4,000, 4,000, 4,000, 4,000, you might be able to put in more than 6 or 10,000. And what I do personally is sometimes I just go into my policy and I do an illustration to see how much can I put in if I wanted to. So as long as you keep that paid up additions rider paid, it keeps the door open so you can put more in. Matt's got a 7-pay premium of $53,433 to my previous question above. Either way, the process has helped like crazy. Happy for all. Is curious about the numbers. So in your case, Matt, that number, you might be putting in, say, 50,000 a year in premiums. The way the policy is designed is it's got a little bit more room. So it'd have, say, 3,000 more dollars before it hits that MEC point. So you have a little bit of buffer in there to put additional money into the policy. So Drew is saying if cash flow is staying consistent year after year, why wouldn't you continue to pay the PUA? Drew, that's a good point. When we do these designs, it doesn't mean you have to stop or you should stop. Here's the principle of it. The paid up additions is going to provide me more cash value growth and benefit in the early years. So the faster we can get the cash in, the earlier, the better the policy will grow. As you mature and the policy gets more mature, the base really carries a majority of the policy. So you don't need the paid up additions, say after year 10, to get the growth happening. It's not necessarily bad to put the money in. If you don't have anywhere else to store it, you don't have another policy, not a problem to keep putting it into the policy. It just doesn't have the same bang for the buck as it does in the early years. And there's the analogy of, has anyone heard the analogy of the rocket ship and the paid up additions? Thumbs up if you've heard it. Drew has, yeah. So for others' benefits, if a lot of people haven't heard this one, is when a rocket is launched off of the surface of the Earth, it has rocket boosters, first stage, second stage, because there's this big heavy thing that we've got to get moving. Think of the policy in the same way. We've got this thing we need to get moving, so we do a lot of paid up additions. Once that rocket is, out of the atmosphere, it's in orbit, by the time it got there, it dropped all the boosters because it doesn't need that extra thrust to keep it going and performing. That's the same concept with paid additions. They're not necessary to keep the policy growth and to be efficient. But if you have nowhere else to put the money, it's not necessarily a bad thing to store it in there. It's a better place to store it than a bank account. Okay, so Jordy's annual premium for the paid up additions is $10,800. Under the additional coverage benefits section of my policy, it shows my coverage benefit as $22,000. I was wondering if my policy was built so that I could add up the coverage benefit amount. Yeah, I almost might need to look at your policy, Jordy. I don't know if the policy was designed to have higher PUAs than you're putting in. So when we're structuring policies, even though we've got this 10,000 going in, if something came up, at a bare minimum, we want to try to get that 4,000 in. And so your policy might be set up to hold 22,000, but maybe you're only putting in 10,000 in paid up additions. So I'd have to look at the actual policy to really understand what's going on there. So do you think it's better to continue paying PUAs year 11 because insurance was cheaper, younger, or better to start another policy? So Eve, this is kind of where my mind would go, is if you think you're going to consistently have more money than you can shove into the policy, I would create another policy just to have that, money working in a second policy and have that growth. I kind of look at my older policies as a place to store money if I get a windfall. So I've got a couple equity plays out there. They're Hail Marys. If those come through, I'm going to have, some bulk of money. And I'm like, where am I going to store this? Because I'll just go backfill loans. I'll put in more paid up additions. I'll just store that money there. But if you consistently have more cash than you can get into the policy, or even, past that, in this case, 4,000, if you have 15,000 every year and you don't know where to put it, maybe it's time to start another policy. But one of the things you'll see is if you continue putting in this 10,000, you're not going to get the same type of growth that you did in the earlier years. So that's typically what happens with the PUAs. We've spent a lot of time on this 60-40. I want to show you what happens with the dump. Yeah, so here's my 60-40 with a $50,000 dump. So now you'll notice that in year one, we've got 60,000 going into the policy. And so now our projected cash value is 54,500. So just out of curiosity, what is 90% of that? So it's about a little over $49,000 is really what you'd have available to take a loan. So why somebody would want to do a $60,000 dump would be, yeah, I've either got a bunch of money squirreled away in a bank account and I'm just not comfortable with having that much money in a savings account in a bank. So that might be a candidate to dump in. That's also helpful if you've got some money laying around, we can put in the policy and throw it at debt. Another common thing that happens is if you are doing real estate, you just sold a property, you could run some of that money into the policy and then take it back out. But we've got to make everything work timing wise so that you don't get stuck into a 1031 issue.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
Let's see, we've got another question. My brother received a high cash value policy illustration from Northwestern Mutual. Wonder if it would work for IBC. Is this possible? Could you help him? Yes, I could help him. So here's the challenge with Northwestern Mutual policies is that I think their loan rates, and this would have to be confirmed, I think their loan rates are about 8% right now. The other thing is if it was designed from someone at Northwestern Mutual, and this is a generalization, so it's not, so Drew says he can confirm that loan rate of 8%. But a lot of times what happens, and even when I started infinite banking many, many, many years ago, the guy that gave me the Nelson Nash book, he told me that they're the expert in infinite banking, and they actually set up some really nice policies. I went to my regular insurance guy that I've got my car insurance, my house insurance. I'm like, hey, have you ever heard of this infinite banking thing? Oh, yeah. We can set that up for you. So they designed policies for me and I compared them with what this other guy built that was an infinite banking policy designer, night and day. And so I think what you'll find is with this Northwestern Mutual policy, they probably set it up where most of the money, most of the premium is going into the base. And it's not going to have a lot of cash value. I've looked at some Northwestern Mutual policies that are older and, they've spent, 15, 20 years paying them. Well, now they're efficient, and can we use those? Yeah, we can certainly use them. The other thing that we also can do around some of the older policies, and let me ask you this real quick. So it looks like it's a newer policy. Is that correct? And if it is a newer policy, I would say, let's try to redirect. If he hasn't gone in force or purchased it, let's figure out if we can do something better, which I'm pretty sure we can. But in cases where someone's got a policy that's 15 to 20 years older, we could still keep that policy around and use it. And there are some ways getting around that higher interest rate. So there's cash value line of credit sometimes you can do. So there's some options, but if you want to have him reach out to me, I'd be happy to help him. You can catch me at craig@themoneymultiplier.com. That's my email. So Drew did a 1035 exchange. To the Rock policy. Yeah, so it just really, it's a depends question. I'm working with another guy right now. We're doing some 1035s of their Northwestern Mutual policy. So it's situational, but if you're just starting off, I would bet that policy is not designed for infinite banking. Here's a cash value analysis for, again, a 60-40 with the 10K, the Lafayette policy with the 50K dump. So there's really nothing magical about it. We're just simply taking that 50,000, dropping it in, and it goes into the paid up additions rider. And so it really gives us a lot of access to cash up front. So one of the things I like to look at is, if I do this, does it change that projected premium to cash? And does it change my projected cash on cash numbers? So I'm going to do a little flipping back and forth, if you will. So here we are at year one, we've got about 90.83% cash on cash, year two, 97, year three, 103. Let's go back and see what it looks like if I didn't do the dump in. So we have a 90, a 97, and a 103. Well, the first year without the dump in was 65, 85, 90. So this is just kind of proof in the pudding, if you will, of what does the dump in do for you. And in this case, it's just really helping juice the cash value earlier. Let me know if there's any questions, but this is just the way it's going to work when you do a dump in. It's just creating more cash for you up front to where you can get that out. Without the dump in, our crossover point, if you will, at year 8, where the amount of premium we put in equaling the cash is about year 9 without the dump in. And if we slip back over to the dump in, it looks like it moved up to about year 7. So there is a benefit to doing the injection of the dump in. So hopefully that's helpful. Now, what we have to do in our designs is I've got people coming to me saying, hey, can I dump in 100,000 and then put in, $5,000 a year in premium? The answer is no. And here's why. Think of the difference between the dump in and the premium. The wider that gets, what we're really doing is we're putting less and less and less base into the policy. And remember, the IRS came along and ruined the party. So we now have to have a certain amount of base for the amount of money going into the policy. And even on those really wide spreads, where if I'm doing 100,000 and trying to put in 5,000 in premium, it's going to require a lot of term to make up the difference of the death benefit. So even if I could, I'm going to put in a lot of term to make that type of a policy happen. So here's what happens on one of the efficiency things that we design is the closer my dump in and my premium are. So let's say 60,000 to a 10,000, let's say it requires 2 units of term. I'm just going to say 2 units of term. If I go 60,000 to a 5,000 premium, I might need now 4 units of term. It just means I'm going to need more term because I'm putting less base into the policy. A lot of people come and they try to build these huge spreads between the dump in and the premium. Just know that we can do that to some degree, but it's just going to require more term to make the policy work. In some cases, that's okay. It's a design consideration that we want to keep in mind here. So Tracy wants to go back into the buckets. When we set up a policy, what are all the things going on inside of this policy? And let's walk through it in correlation to this illustration. This annual premium bucket, where I've got the 10,000, the 10,000, and eventually the 4,000. This annual premium is this premium bucket. And what happens is any money that goes into this bucket, it will compound uninterrupted for the rest of that insured person's life, okay? So if I put $1 in here, it's now in this bucket, it's going to be working, and let's say, so Tracy, let's say that you're the insured. For the rest of your life, every dollar you put in premium, it's going to compound uninterrupted, whether you're using the money or not. So this bucket is really important to remember. We're not going to stop this. This is a runaway train. It's just going to keep getting better and better every year. When we look at this guaranteed cash value or the projected cash value, they're both measurements of cash value. It's just that one's a guarantee, the projected is the one with the dividend. So this number, the 6,572, the 15,155, the 24,205, that's what represents this cash value bucket. It's simply an indicator. Almost think of it as a gas gauge. How much funds do I have in my cash value, or how much gas do I have in my gas tank? And this is what's available to you to take against as a loan. The proper way to look at this 6,572 or this $15,000, this is an advance on this death benefit. So if I use it, the insurance company's like, hey, cool, that's fine. You can use this 6,572. You can use this $15,000. But if you don't pay that back and you pass away, they're just going to deduct it from your death benefit. That's why they don't care. Back to when Darren was asking about how do we pay back the loans, the insurance companies don't care when and how you pay those back, because they know at some point there will be this event called graduation and they will get their money. And if you look at the balance sheet of the insurance company, you'll see, where they put their money in. Policyholder loans is a big portion of that. So they know that they're going to get their money back eventually. So this cash value bucket is going to go up and down throughout your life as you use this money. So if I take out $10,000 in year 2 as a loan, my cash value is going to be $5,155. That does not stop this bucket from growing. And this is a very, very important point to remember. The money that I'm using in a loan is indicated here saying, well, you went from 15,000 down to 5,000. That's just what's available to you to use, but your full amount is still over here cooking and growing year after year after year. Your death benefit will also continue to grow if we look at this illustration. See how our death benefit keeps going up and keeps going up. In a traditionally designed policy, this is typically just one number and it's flat for the rest of your life because there's not a lot of cash value growth that's buying more death benefit. So did you know that a paid up addition is almost like having a separate life insurance policy, because what it's doing is it's buying death benefit, but we just keep it all in one policy. So the reason our death benefit keeps going up year after year is because the paid up additions and the cash value growth are buying more death benefit. That's why it keeps going up. That's why our projected cash value keeps going up and we have more and more money to continue to use. So these 3 buckets are really the 3 primaries that are going to be related specifically to your policy. Then we've got the life insurance general fund. When I take a loan out, it does not come out of my account. It does not come out of my bucket. It comes out of the general fund of the insurance company. If you look at the balance sheet of the insurance company and you look at their investments, you'll see policyholder loans and how much is coming out of that general fund. When you pay a loan back, it goes back into this bucket. When you overpay the loan, now you've got more money to put in than you owed the insurance company. We're going to fill up your premium bucket as much as we can that year. And then if you can't get all that money into it, then just put it in a segregated account and use it for next year. So hopefully, Tracy, that helped. If not, please let me know. And then Garland is asking, can you explain the decrease in death benefit in the far right after policy has been funded for several years? So are you talking about this projected death benefit increase where we get the negative? And I think that's what you're referring to, Garland, but essentially what's happening here is in this policy design, we kept the term on for 10 years. So if I go back into, this is not the exact one, but remember how we have these term riders? So we needed $75,000 of death benefit to make the policy work so that it wasn't a modified endowment contract. So when you're looking at your policies, sometimes what you'll see is, they're at year 11, we have a decrease in the amount of death benefit. That's because the term rider dropped. We're no longer paying for that term insurance. We no longer need it to make the policy work based on the amount of money we have in it. So that's why your death benefit decreased from 298,000 to 231, or in this case, Chris's death benefit did. If death benefit's important, can you keep this on longer than 10 years? You can. You could keep it on. I think it goes up to 20 years as the maximum. So if you want to keep that death benefit on, that full term rider on, you can continue to do that, but that's a cost that you'll have to just keep paying into the policy. So Garland, let me know if that was the question you're asking and if that was answered sufficiently. Going back to the calculator. So I'm not quite sure you're asking about this calculator. Were you talking about the loan calculator? So let me know what you're after on the calculator. And I don't know if you were referring to this thing, but this is a spreadsheet. And really all this is just a spreadsheet showing a simple interest calculator. There's a couple different sites out there I like to use for calculators, but I'm also known on the team as Mr. Spreadsheet because I put everything in stinking spreadsheets. So there's a spreadsheet to solve every problem. But anyway, let me know if that's what you're after, if it was this calculator here. Let's see here. Tracy, can you name your top 3 carriers and why you like them? I would say Tracy, there's really 2 that we work with primarily, but there's others. One America and Lafayette, I would say would be probably the two that we do most of the business with. Are there others? Yes. Why do we have others? Why would we go with one versus another? Let me just tell you, if you're in New York, you're in a special category because their laws are so different. And there's some companies like One America doesn't work in New York. Penn or Security Mutual Life or Guardian, they'll work in New York. So we'll use them for New York customers. But outside of New York, a lot of times One America or Lafayette would be the two that we use. Why do we use those? One, they're very great companies to use for infinite banking. They support infinite banking. One America, we've got great relationships with them. We've got great relationships with Lafayette. Why would I perhaps use Lafayette over One America? One use case of many is if you came to me and we're really trying to stretch out the dump in to the premium, the difference between the dump in and the premium, if it's really large, Lafayette allows a bigger spread typically for that than One America. Can we do some things in One America to make that work? Sometimes. It's one of those things, Tracy, where if I've done my job properly and I understand what you're trying to accomplish, I will go find the best tool for that job. So that's really what we focus on and what we do. Meritas, we don't work with them. And matter of fact, I don't know off the top of my head if they're mutual. So what we're typically looking for in criteria is they must be a mutual company. We want them to be non-direct recognition, which that's preferred. And I don't know if you've come across that term, but just think of it this way. There's companies that are non-direct recognition and there's companies that are direct recognition. What that relates to is how does that insurance company treat the loan? If I take $100 and I put it into a savings account, I'm earning interest on that $100. If I take that $100 out, I'm no longer earning interest on that money. That's kind of what a direct recognition model looks like, where the insurance company says, hey, if you take a loan out, we're going to take that amount of money out of that compounding equation. However, this gets complicated. There are crediting and different things that some of these direct recognition companies do. So they try to say, well, it all comes out in the wash. It just adds more confusion to my life. And that's why I would prefer to work with a non-direct recognition, where if I put my $100 into the savings account, I leverage that $100. They don't look at that as me taking the money out of that premium bucket. So, and again, I don't know a lot about Emeritus. Gabby, I don't know if you've run across them or.
No, I really haven't. In our arena, we don't really talk too much about them. So I would say if we don't really work with them, if we haven't studied them like the other companies, I personally would stay away from them. But again, I don't know enough to say that for sure for somebody else's situation.
If you're working with another company, the important thing is to get the understanding of how they design that policy. How do they put your premium to work? Do they stick it all in base? And you have to just be really careful out there because, and this comes, and Gabby can validate this as well. We've got so many people that come to us that have already talked to somebody that may have said, yeah, I'm an infinite banking, I can design your policies, and they just aren't designed properly. There's a lot of groups out there that do a great design. So you just have to really find someone that knows and has the experience of how to design these, how to, turn all the dials and make it work for you. That's just something I would caution you on. I don't know about the company. I don't know, how they design their policies or who works with them. But anyway, that would be my comment there.
Yeah. And just so you guys know, not every mutual insurance company is a good fit for what we do or will want to do it. A lot of them just say no. So just because they're a mutual insurance company, even if they may pay dividends as well, it doesn't mean they participate with infinite banking. So just make sure you do your homework.
Let's see. So there's a question, would it be wise to take out a loan to pay off debt or just use cash on hand to pay off the debts if we have available? My concern is using cash, then having it repay the loan and the policy premium, or should I be looking at this differently? Yes, you should be looking at this differently. And here's why. If you have third-party debts to pay off, you have a couple options. One, you can just pay those off on the schedule you're paying them off. And when you're all done, your debts will be gone and so will all of your money. Okay, so that's a valid option. The way we structure it is that we look at paying those debts off, but running the money through the policy first. And you're going to end up paying the debts off in about the same amount of time. So with infinite banking, we can pay your debts off, your third-party debts off faster. But then you have a policy loan. So what we're going to do is take all the money that you were paying to those third-party debts and run it back into the policy. Here's where it kind of, it ends up. It's going to take you about the same amount of time to pay those debts off. Option one of paying out cash, debt's gone, all your money's gone. Option two, using infinite banking, your debts are gone and you recaptured some amount of that money is now in your system. And you can use that again to go buy the next car or to go fund an investment, whatever it might be. So that's really what it comes down to. And that's what our implementation team is really geared towards helping you with. So here's another thing. And you asked about insurance companies, or Tracy asked about some of the insurance companies. We had some discussion about that. There's a lot of people that can help you set up a policy. Great. That's important. There's a lot of, and I would put myself in this boat. When I started 14 years ago, I just got, the policy set up, tap me on the back, good luck, go prosper and do great things with this policy. I didn't know what to do. I didn't know what to do next, but I knew I had a policy. We have this implementation team that will help you with that debt pay down. So you can meet with them quarterly, whatever it might be, but we will help you figure out how to take those loans out, how to pay off that debt, how to restore the policy. And really at the end of the day, it's, do you want to pay all that money out and have your dollars leave your economy? Or would you rather come up with a strategy where you can put your money into your own system and leverage it, pay your debts off, and then recapture it? Those are the two things that I would say on that question. So, well, thank you all for joining. I love the participation. We've got this recorded. Gabby shared the link, but let's call it a wrap and ask me anything's on today at, 4:30 Eastern?
4:30 Eastern, yep.
4:30 Eastern. So we'll hopefully see you all there.
Yes. Thanks, guys. Have a great day.
All right. Thanks all. Bye.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.